Okay, we're trading the New York session, so this is an update for beta program. It's officially titled Forex Mastery and Monetization Blueprint. That's the beta program. So this video is for those coaching students, and there's still time if you're interested in joining. There's approximately 25 people total. That's the limit that I'm allowing into this particular beta program. It's a 6-week program. So this update is for them. And the information that we shared throughout the trading sessions, the trades that I call out for them, things like that, the updated information as far as what trades am I looking at, potentially executing what currency pairs, what I'm looking at, why I would not execute certain trades, and why I am thinking about executing other trades. So just the thought process behind how the day is sort of developing, and what I see, and what's confirming opportunities for me, and at the same time there are other areas or situations where I would consider just avoiding trades altogether just because of the volatility on certain days. So this will give you a good idea of what I'm looking at today. So I'm going to start off with the most recent one. So we had a continuation breakout trade, and I called that trade out for the beta program members, and it was tied to the breakout on the dollar. So inside of the Facebook group, the Forex Day Trading Academy group, I had been posting some images of the dollar index. So I'm going to go over here to the dollar index. And I was sort of updating it and posting it there because I wanted people to see more or less what I was doing and what I was anticipating, and when I would expect to get into the trade. So if you go into the Facebook group, you'll remember that there was a price swing high, there was a key level of resistance, another one, and then there was that price swing, that spike here. This is the dollar index. This is the 1 hour chart. So when I'm looking to execute trades, and you probably know this by hearing and working with me for a few weeks now if you've already been in the beta program, when I look for, let's say, a continuation breakout trade on one of the Forex majors, euro dollar for example, I would like to see confirmation somewhere, and usually I'm going to get that confirmation with the dollar. So when I see a continuation breakout trade develop on the dollar, then I'm going to look for the opportunities in Forex. Now sometimes one Forex currency pair, if there was, let's say, a continuation breakout trade set up perfectly on the dollar, sometimes one of the Forex majors, maybe one of them would set up a trade at the exact same time that the dollar's giving me a signal. And then maybe the pound dollar or the dollar Swiss or the dollar yen, they might set up a trade an hour later. They don't always set it up at the same time. For example, we had a breakout trade on the pound about a week and a half ago or so, and beta program and coaching students were watching this trade unfold. So it developed on the pound yen first as a continuation breakout trade to the downside. It paid approximately 85 pips. We were just trading it to the psychological level. And then an hour later, the pound dollar printed the same signal. It just, again, they don't always set up the trades simultaneously, even if it might be one of the same currency. So example, again, the pound yen set up a trade to the downside an hour before the pound dollar did. And then the euro dollar really wasn't doing anything. It was just going sideways, and we ignored it. So here with the dollar index, there was a continuation breakout trade. So prior to that breakout, I was posting images and my thoughts that it's still moving sideways, still inside a consolidation, and I'm, for the most part, not really expecting to do anything. And it will normally affect the Forex across the board, usually. But it doesn't mean that one of the Forex currencies might not experience its own breakout and its own movement by itself. Like, there's a reason why that happens at times. So you got to be sensitive to it. You have to know what else you could use in addition to identifying why the breakout, why the move, what's the news behind it, but also the technicals. After I posted one of the last images on this dollar chart earlier this week, we got the continuation breakout trade signal here. This indicator down here, I'm sorry about that bandwidth. This I'll have to change this. This is a different page than I was originally posting my images on. Again, with the continuation breakout trade, I'm using 3 primary indicators: the Bollinger Bands, the CCI, and the MACD histogram. Obviously, the CCI and the MACD histogram are not on this chart, but that's what would be required to confirm that trade. This is something that I would use more or less for reversals and to identify maybe a top, a temporary, even if it was temporary, and where it's likely to either slow down or maybe even reverse. This would be one of the indicators that I would use to identify a bottom or a top to help me identify. I talk about that in the lessons inside of the membership area, but we also talk about that when we're trading during the New York session, sometimes during the London session when they develop. When you go into the chat room with me, we talk about this. Like I explain the setup at the current live candle, what it looks like to me, what I can anticipate, and basically I'm teaching you and reviewing a lot of the strategy and the basic rules that coaching students are learning through the beta program. So there's that constant, we're constantly drilling on the basics all of the time. So when you join into the chat room, I'm reviewing the same thing over and over again. This breakout trade paid and moved, right? And what I mean by paid is that it went into profitability here on the dollar, which gave us the trade here on the, let me switch pages here, on the euro dollar. I'll review this page here. I'll show you some of my, I want you to see the reversals and how I set that up. And usually it's long before it actually happens. This is not, again, I apologize, this was not the chart that we were trading off of, but there's the continuation breakout trade there on the euro dollar to the downside. So again, we wait for the breakout. We have a range of consolidation, and we were talking about that range of consolidation for the last week and a half or so. I'll go ahead and tighten up the charts and you can see how far back it goes. It was this range of consolidation all the way back to that peak high there, which was August 6th. So then we get the breakout, and the breakout basically occurred at the same time that the dollar breakout developed here to the upside. So that was my confirmation, looking at the dollar and then switching over, looking for an opportunity. The other currency pairs weren't really moving and weren't providing the breakout trade, and this one did, the euro dollar, by itself, on its own. So again, we look at the indicators, make sure that the Bollinger Bands are separating away from each other on that candle. So this one had a first target of 30. And I believe it dropped down to, I made a video, it was live. As I was talking, it had hit the 31 and 30 level, which is what we were targeting. And that video is posted in the membership area, in the updates. I think it's section 13 at the very, very bottom. So if you want to go and watch that live trade unfold with the continuation breakout trade and what I was using for confirmation at the same time it was setting up, that's a really good video to watch. You'll actually watch it, from basically the start to the finish and how it worked. Now, when we talk about scaling out, as I mentioned, the first target was 31 or 30, which was here, and then the final target was 95. So for coaching students and people in the beta program, you're being taught that one of the safest ways that I execute and use these strategies, one of the safest measures that I can put into the system so that I can protect myself. Let's say a trade doesn't necessarily, especially in this environment, we'll see breakouts and then they'll move to the first targets, but they don't always hit the second targets. And we're getting these really short-term trading opportunities. Sometimes they'll last an hour, sometimes they'll last 2 or 3 hours, but the market isn't really necessarily willing to hold on too long, and you get a lot of profit taking shortly after people are getting in and out. That's on a really small time basis. That's a lot of the behavior that we see here and the choppy movement. Overall, people that are in a longer term position, they're not necessarily likely to trade in and out. They've already made their decision and they're not going to touch it. And there's a different percentage of people that are doing all of these different things throughout the day. You get scalpers, you get people who are in and out, you get people who are getting stopped out, you get people who are holding too long. There's so many different things going on here. So in an environment where we tend to see people get in, get out real quick, get in, get out real quick. And real quick could be, it's all relative to what you decide to do and what the next guy decides to do and the next woman decides to do. Some people will hold for 7 minutes, some people will hold for 15 minutes, other people will hold for 2 or 3 hours to see what's happening. It all relative to their own individual way and style, and the amount of time that they have to trade. So many things are going on here. We have to incorporate all of that. We have to anticipate that. And when you can see that in the price structure and the price swings and the way they're moving, well, we have to protect ourselves. One of the ways to protect ourselves is to scale out of a trade. And that's true even if we were in a good, solid, trending market environment, and there wasn't a whole lot to really worry about in terms of how jittery or jumpy traders are, and the market is reacting to tweets. You get a move to the downside and it looks solid, it looks good, it's trending, and you're up 17, 18, 19, 20 pips, and then somebody makes a tweet 15 minutes later and the whole thing spins around and goes the opposite direction, and it goes up maybe 30, 40 pips. We've seen this happen over and over since it really started to pick up momentum like that in July. And you've seen many reasons why. I try to post some of the tweets that I actually see that would describe the that type of price action, so that way you get a better understanding. But know that the market is reacting to things like that. They are on an intraday basis. Day traders, scalpers, they're reacting to that. They're looking for these small opportunities to either get in, get out, or close quickly, and it's exaggerating these intraday price swings. So again, as I mentioned, you might be looking at a good solid trending move. Normally, we don't have to worry about scaling out. I still recommend locking in profits when we scale out, but scaling out is one of the things that I implemented into my trading strategy back in 2001, and it changed the results. Prior to that, prior to really sticking to a scaling out strategy, I was just getting in with whatever normal lot size, whatever normal lot positioning that I was using, 1 lot, 5 lots, 10 lots, whatever it was that I was doing. And I would just, it was one trade, one target, and I closed everything out. And now I understood the concept of scaling out back in 2001. But as I've mentioned, and you've probably heard me say many, many times, I worked and hired a trading psychologist. I went through the same experiences that most retail Forex traders go through, and even professional traders. We go through a period of time where we're tested and we get off balance for whatever it is, and it's a psychological thing. It really is, and you sometimes you just need some help and to work through that and to get out of it. And one of the first things that psychologist had asked me was, "Are you scaling out? Are you scaling out of your trades?" And it was a really important component to successful trading. It was so important that they brought it up right away in the beginning, and it had nothing to do with my trading strategy. They weren't helping me with my trading strategy, the technical side of it. They were just helping me get my mind around and putting these things in place that help anybody when they're trading. So I started figuring out, where could I scale out? Like, if I'm going to take these trades, what would be a safe place to trade? And we talk about the continuation breakout trade, that sometimes if you're looking at the 1 hour chart, the 1 hour time frame, and you get a continuation breakout trade, one of the first things that I always tell coaching students is that, for example, this continuation breakout trade yesterday, when you see that candle, it's easy to just focus in on what's going on right here and maybe look at this range of consolidation and say, I've got one. But at the same time, as I mentioned, it's easy to do that and look at just this time frame and ignore and maybe be a little lazy in terms of looking and stepping back and looking at the larger picture, the bigger picture in the 4 hour and the daily. If price has been in a consistent downtrend, and this is another continuation breakout trade, you've got to ask, where did all of this come from? Where did this initial, or the one continuation breakout trade that you're looking at, where did it start? Were there previous continuation breakout trades? I'll just leave it there. Were there previous continuation breakout trades in the same direction? And if it was in a downtrend, and this was, let's say, and you can tighten up the charts, or you go to a 4 hour chart, and you can see that there were several all the way down. It's been going on for maybe a couple of weeks. Eventually, one of these continuation breakout trades in that trending direction is going to run into a major support level. And you may not be able to see it here on the 1 hour chart. And that's why you got to step back and take a look at the 4 hour and the daily to identify where those significant support levels are. Because what will happen if you're not paying attention, and let's just say, for example, this was a critical support low on the daily and the 4 hour. Just for example, let's say it was maybe right about here. The 1.1140, let's call it. This is just an example. If I take this continuation breakout trade without paying attention to where significant major support is, it may not move to the 55 pip target. And if I don't scale out, this could turn into a loss if I'm holding only for that 55 pip target. Because as I teach the continuation breakout trade, I'll tell you that it reaches the 55 pip target 90 to 95% of the time, but you have to know when to use it and when not to use it. So if you go into the modules, the membership area, there's I talk about the HL30, for example. And one of the key components to making the HL30 work better, it's another trading strategy, it's in the membership site, is one of the key basic principles to improving the number of winning trades, regardless of the strategy, and to eliminate more of your possible losing trades, or more of the losing trades, is knowing when to execute the trade and when not to execute the trade. And if it was going to run right into a major support and it wasn't that far away from the entry, and let's say that 55 pip target was way beyond or way below the actual serious significant 4-hour and daily support, and there were multiple continuation breakout trades to the downside here, and this happened to be like maybe the third or the fourth one, I'm going to be suspicious of that move. But I can only be suspicious of that move and protect myself by stepping back and looking at the bigger picture, the 4-hour and the daily. So it's critical when you get the signal candle to say to yourself, well, where did this come from? If you just look at this time frame, it would be easy to say, well, this is just consolidation, and this is where it started. This is all there is to it. But that's not the whole story. Now, of course, this is not that perfect example if you go back over here. So I don't mean to say that it's been in a constant downtrend all the way through. There was an uptrend and then it went sideways and now it's moving down, that kind of thing. But you get my point. My point is, when you get a continuation breakout trade, you need to be aware of the environment. You need to be aware of, is this the first one in a reversal of a previous trend direction, which is what we see here? Or is this the second or the third or the fourth or the fifth continuation breakout trade in a downtrend? If it's the third or the fourth or the fifth in a downtrend, you want to be looking at the larger time frames to find out where that area is, that support area. At that point, if I was going to take this and it was still a perfect continuation breakout trade, then it's critical that we scale out at the first 20 to 25 pips. It's so important that we do that. It's one way to protect ourselves, because if for some reason it doesn't go down to that 55 pip take profit target, we still lock in the 20 to 25 pips. In order to do that, you're probably going to have to execute two trades. If you're trading standard lots, cut that standard lot in half. If you're trading mini lots, cut the mini lot in half so that you can open up two trades. Close the first trade at the first target. Once it hits the first target, there was the first target, then we set it at a break-even stop. So this is something that we talked about yesterday, and I've been teaching this method for years. Back in 2007, when I opened up my chat room, we would see every once in a while this scenario that's about to set up, and my students in the chat room, people that were following my trades, I was calling out trades live in the chat room, and I still do today for the beta program members. Once they're done with the 6-week program, they move into the chat room and I call out trades there during the trading session. So one of the things that we talked about in this chat room, as far back as 2007, but I've been using this strategy since I developed it, is that every once in a while it will hit the first target and I lock in profits, right? I close the first lot or the first position at the first target. And then I set the second, after it's hit the first target, only after it's hit the first target. And then I set the second lot, the second trade, which is still open, then I move it to a break-even stop. So if my entry is, let's say, 51, then if price comes back up to, let's say, 50 with a 1-point spread, or 49, then the second trade or the second lot would be closed at 0, at break-even, 0. And we would still earn the profits from the first trade to the first target. And that's okay, that's good. That's one way to protect ourselves, scaling in, scaling out. Often, if there's significant economic data that's driving this, it will usually, for the most part, go pretty in a consistent manner to the final 55 pip target, and there isn't as deep a retracement where it would go all the way back up to the break-even stop. So the second lot will continue and remain in the trade to that second final target, which is 55 pips. At that point, then we know we're safe. We've protected ourselves. we don't lose any. Now, every once in a while, and I remember this vividly back even in 2007 when I first opened up my first chat room. I would have new students and we would lock in profits on the first target here, and we'd have the second trade open, and we knew that if price came all the way back up to, let's just put 49 in here, 49 right here, something like that. If price comes all the way back up here, then we're flat. We've only locked in the 20 pips, but we're flat at that point. In this example, price went all the way back up to here. It exceeded 49. I think it went even a little bit higher. There's a few spikes here. That one went up to 53. So while I would trade live in the chat room, this goes back even, I mean, this rule's always been in place. I've always used it, even as far back as when I started sharing it back in 2007 in my chat room. My students, my coach, my subscribers in the chat room would say, okay, what do we do now? Like, what if this is just a retest, like you say, and it goes back down and goes to the final target? Well, sometimes if we can tell that it's just a retest, because it'll do this sometimes. It'll go back up to the break-even stop or back up to the entry, and sometimes it'll exceed the entry by maybe 2 or 3 pips. And I'm willing to, if I can identify that this is just a retracement and everything else still remains intact for this trade, and I'm expecting it to continue to go lower to that final 55 pip target, I would be willing to give up 2 or 3 pips that I earned on the initial first trade to the first target, and that's it. 2 or 3 pips, that's it. I've got to watch it closely. I've got to honor and respect what I'm thinking here. I'm only willing to give back 2 or 3 pips on a retracement because I know that this happens every once in a while. Now, this is a 1-hour chart, so many hours are passing here. So it's easy to start changing your perception and your thinking and your plan, but that is how it works. If we just step back and we look at what's happening here, we look at the signals and the clues that these candle patterns are presenting to us, and we pay attention to that information, not what's going on in our head and we're thinking, okay, we're going to give back all of the profits on it. You don't think about that. You think, I'm only willing to give up 2 to 3 pips that I earned on the first trade to the first target if it looks like it's holding here and it's not going to go too much higher. In this instance, it went a lot higher. So at that point, we would close the trade, but that's not always normal. So at that point, instead of earning 20 pips, perhaps we would earn 15 pips. Now, it ended up going back down here to the target of the 55 pip target. In a more normal environment, let's say in September, October, November. Now, I'm not making any promises because I can't predict what September and October and November are going to be like. But when it returns to a more normal environment and the market isn't reacting the way it is today, which is normal, the way I describe it, in a normal environment, it will maybe retrace and go maybe 2 or 3 pips above the entry, and then it'll return. And it usually won't take this long anyway. The fact that it took this long for price to resume in its downtrend and then hit that target, which was the original breakout, so there was really nothing wrong with the trade. And it is true that if you held with one lot to that final target, you would have never been stopped out. You would have earned the whole 55 pips. But just because it looks like that here on the charts doesn't necessarily mean that that's the way you should trade it. We're trading the way we are and we're scaling out the way we are because we're suspicious of the way the market's reacting and how fast it can turn around and reverse and go the complete opposite direction and wipe you out on a trade when it looks perfectly good. And all of that could happen just because of a tweet. It has happened. It's happened several times since July. It happened plenty of times before, but it's really starting. I shouldn't say started. The market, you can see that the market is reacting. You can almost count on a specific tweet causing a reaction if you understand the outcome of what they're saying in that tweet, is what I'm getting at. It is something that the market is reacting to. When these events and the uncertainty, when we pass that cycle and we go back to a more certain environment, which is what markets need to consistently make money, you're reading all the time, Managed funds are having a really hard time. Everybody's having a hard time. People are getting chewed up on their trades. Everybody wants to know what's happening. So again, a lot of it on an intraday basis, when we're using certain stops and targets and things like that, it is the reaction to a lot of that short-term speculative information that's coming from sources like Twitter. And we all know that while Twitter can be a good resource, when somebody's like retweeting something, should you really trust that? And it's almost like the market reacts first and then tries to figure out if they trust it after, and once they're already in the position. And if it's not something that they're too comfortable with, then they cut out on the trade. And we see these real quick moves. This one in itself, the fact that it took this long to come back down here, because structurally there was nothing wrong with this continuation breakout trade. If you'll notice, it's the common cycle of a breakout where it moves. Sometimes it'll give you the entry, move down a little bit, and then it'll come back up and retest the level that it broke out of. That is exactly what it did. And I know I quote John Bollinger all the time. I'm a big fan of John Bollinger. I like him. I like the way he trades, the way he thinks and processes. The information is basically, I mean, it resonates with me, so there's no resistance there. And he talks about, and he's not the only one. He didn't invent these things, but he talks about how very this is healthy when you see a breakout and then a retest of the level that it broke out of, and then you get where the trend ends up resuming in the direction of the breakout. So that's a healthy process. It doesn't always happen. Sometimes it'll break out and then drop. And that is due to obviously the market reacting to something big, something taking place, whether it's economic data or a serious statement that could affect, monetary interest rate policy. So there's different things going on here, but the fact that it took this long to move like this, that by itself was also a clue, right? There isn't a whole lot of participation at that time. Maybe there's more people waiting and watching than there is actually participating, and there's not a lot of movement. Whatever the case is, whatever we can determine, this behavior here isn't that normal market environment, but we will return to that normal market environment where things are consistent and reliable, because that's what the markets need. Again, as I mentioned, when we get through this cycle of uncertainty, we will return to, and it's almost like looking at price coming into a really tight range of consolidation. When you see that, you're going to get a breakout. And then when you get a trending move, you're going to see it stall and then move into consolidation. And it just keeps cycling just like that. Or the same thing with news, and the same thing the way we're reacting to, and the markets, the way they're reacting to our intraday, bits of information through Twitter and Facebook and whatever other sources they can get it from. It won't be as important, and it'll be business as usual. And then these trades won't necessarily work like this. They'll work a lot quicker. There's going to be a lot more trust and a lot more participation in a trade like this. This is the euro dollar. So many people trade that. I want to say everybody trades it. They don't, but you get my point. This is a really big trading opportunity, and it's one of the first things that people look at. They look at the pound dollar too. I'm not saying it's the only one. I'm not saying it's the most popular. It'll go through cycles, but you get my point. It is one of the majors. And it is one that most likely everybody's going to end up trading eventually at one time or another. So there's going to be a lot more participation in this behavior. This is like, again, 1 hour candles. What is this, like maybe 18, 19, 20 hours before it ends up dropping and coming back down. So structurally, there was nothing wrong with the continuation breakout trade. But in this market environment, we are going to continue to scale out. Sometimes it's going to pull back a little bit deeper than we want it to. And we're only going to earn whatever is available here, 20 to 25 pips. That's the way it's going to work right now. That's the way I continue to believe that we should continue to apply this scaling out strategy to protect ourselves because of how quick we can see things turn around and go back the opposite direction. This, again, the confirmation throughout that process was here on the dollar. This was, again, it did the same thing. So we got the breakout here on the dollar. It moved up. I mentioned earlier it paid. What I meant was it went into profitability. And then it came back down, tested the level that it broke out of. Again, that really common, healthy price structure. And then it bounced and continued right on up. The same thing. The same thing happened here. but it's not necessarily happening. Let's say on the pound dollar or the dollar yen. So I got a lot of questions today about the dollar yen. We'll go to the pound dollar first, just to compare the way it's moving. So the pound dollar moved differently, but did print a continuation breakout trade with no 3-pip entry at that point. So with this pullback, I don't know if it's going to bounce and eventually take out that high. We've got a lot of resistance ahead of it. We've got, I'll go ahead and put one in here. We've got a high here, 2208 approximately, another high here. These are just intraday levels. So, on a larger time frame, it might not even look all that significant, and you might see a 4-hour strong bullish candle that will just blow right through it. That's also a possibility. So we're going to continue to look at the larger time frames as well, but we've got a clear low, a clear high, and then consolidation all through here. This is the 1-hour chart. So we finally got the break. So it was moving differently than the dollar, than the euro dollar. As a matter of fact, the euro dollar was moving to the downside while the pound dollar was moving up for the most part. Going over here to the dollar yen. So this has been a pretty choppy, this is the 30-minute chart for the dollar yen. This has been really choppy. So there was a breakout last night to the upside. Looked great, but there was no follow through. And it dropped and it collapsed. This is repeating this pattern over and over again. This one actually took a lot longer. They're starting to happen a lot faster. You get a bullish move, people pile in, maybe they get in too late. They don't know why it's moving. They get in filled, with a really sloppy fill, not where they necessarily want to. And then they immediately become negative as this thing starts to roll right back down and test this support level. And I didn't take it. I didn't want to take it. It didn't look like a clean setup. It certainly wasn't a continuation breakout trade. It certainly didn't take out the highs from yesterday. So, I stayed away from it, and I end up avoiding getting stuck in a situation like this, which is a good thing. I don't get a signal. This, to me, for the most part, is consolidation. You can see it, excluding a few spikes to the upside that don't go anywhere, and then these reversals that don't take out the lows and stop, and then bounce again sharply for 30 minutes. And then go sideways. There's no follow through here. We're getting these quick short-term reactions to, let's say, a comment or news. And this is what I refer to. This is exactly what I talk about when I talk about these 30-minute to 1-hour trades. When I say that, when I use that phrase, 30-minute to 1-hour trades, this is what I'm talking about. It's these moves or these rallies that last 30 minutes and then they don't go anywhere. And if you were to switch to a 1-hour chart, I'll switch to a 1-hour chart and we'll look at the 1-hour charts. So you can see how the 1-hour chart, there's a great move, and then it stalls. But the 30-minute gives you a better picture of what's going on. For the first 30 minutes, it rallies, closes towards the highs, and then it doesn't go anywhere. It just stalls and goes sideways. These are those 30-minute to 1-hour trades. Sometimes we get signals prior to that bullish move during the New York session. When I get a signal, then the next candle, usually the 30-minute, will rally for 30 minutes, and then I'm in, I'm out, I trade it to a psychological level, and I'm done. And then at that point, if the structure looks like this, I would expect it to flatten out and go sideways. And you can see how each one of these candles is just getting smaller and smaller. Less participation, less momentum, less volume. Now we're sitting and waiting. In and out, in and out. That's what's happening a lot lately. And again, that's another reason why I recommend scaling out. So in this instance, again, it didn't really give me an opportunity to get that 30-minute signal prior to this solid 30-minute move. But very often, prior to these 30-minute moves, I get a signal, and I just wait for the candle to close, and I jump in, and this one takes me right into it. Sometimes you can see it setting up. Sometimes you can't. When I can't, I do nothing. When I see it, I didn't see it today because it didn't give me the signal. I get in and I take it, and it works. So today I did not get any of those signals. You can clearly see that there isn't really any signal prior to these sharp moves. And again, I think that when a lot of traders, inexperienced traders, especially today in this market environment, I know I keep using that phrase, but for lack of a better way of describing it, I mean, it is what it is, and most people use it. So during this current, markets are suspicious, right? They're going to get in and they're going to get out anyway. So when you see price rallying, maybe novice, inexperienced traders, people are impatient, they're waiting for trades. They see, 10, 12 hours of tight, flat, sideways moving price action, and they want to trade, they want to trade, they want to trade, and maybe this is one of their favorite currency pairs, and they see it moving, they don't know why. And again, when you see that, depending on how fast it's moving, be really careful, because you may not get the fill that you want. And if you don't have a target, then you're likely to hold on too long, and the whole thing will roll over just like it's doing here, and you get stuck. This is, for the most part, right in the middle of this range of consolidation. And when I see that, as much as I'd like to trade some of these patterns, they don't always work. So again, you might be lucky to scalp a little bit, but if you don't know why or where it's going, and if it's going to hold or be sustainable, then I wouldn't recommend trading it at all. I know it's hard, but I learned the hard way just by simply losing so much money in trades and in situations like this, that once I can clearly identify consolidation, it's just easier for me to just wait until the breakout. Because even trying to trade off of support and resistance can sometimes be really difficult. It may not always go somewhere. It may look good, but again, depending on where you get in, the whole thing could roll right back over and you could get stopped out, within a session or two, and it's not worth it. So at this point, I have not been trading the dollar yen. It's just too choppy. However, the longer time passes, the more time goes on to the right. We see more data to the right of this chart that we don't have just yet. The more that takes place, the longer that happens, and the longer it remains inside of this consolidation, then it solidifies this consolidation, and it gives me a clear continuation breakout trade, which is like what we did here with the euro dollar. And that's part of the patience, right? A lot of people say, well, you haven't been taking any trades for like a day or two. What's going on? Why aren't you trading? I'm not trading because there just really isn't anything reliable for me to trade, as I showed you in the dollar yen. And then all I've got to do is wait for the breakout and then look for confirmation somewhere, and there it is. And it works out relatively. I mean, most of the time it's going to go to that 55 pip target. This isn't normal, but it's to be expected. And there was nothing wrong with this. So this is what I'm waiting for if I decide not to trade inside of a really choppy, tight, crazy range where price reverses because of a tweet. I talked about some of these indicators. So these are some of the indicators that I would use to identify tops and where it's finally topped, even if it was just temporarily. If it's made a peak, it's not really necessarily going to go any higher, or a bottom. Using these indicators, bandwidth and percent B, along with the Woody CCI, and I'm going to use these differently, but I do put the Woody CCI in here just to save some space so I don't have to switch to another chart. But I'm doing two different things with it. In a situation like this where you see a rally, like these indicators here aren't going to help me find a bottom inside of consolidation necessarily. It's not, and again, the longer it continues to remain inside of this range of consolidation, then these just don't matter. Now it's just a matter of waiting for the breakout. But in a rally or a move, whether it's up or down, these indicators are going to help me identify when it's topped out and when it's time to either get out, lock in profits, or just stay away. That's something we talk about quite a bit in the chat room, and I have modules in the membership area that will explain what I'm doing with these indicators, how I'm incorporating the Bollinger Bands to identify tops and bottoms. So there's different ways. For example, you may hear me talk about 3 pushes to a high. I think I have a video and a worksheet and a manual for the 3 pushes to a high in the Facebook group, in the Forex Day Trading Academy Facebook group. The Forex Day Trading Academy Facebook group is not the same Facebook group that the beta program coaching students have. They're in an entirely different Facebook group. But in the free Forex Day Trading Academy Facebook group, I have videos on how I'm using the 3 pushes to a high, how I'm using and trying to identify W bottom patterns. Usually it's going to be more effective on a larger time frame, but it doesn't mean that you can't use it on a 1 hour chart. It is more effective again on the larger time frames, and it helps. But for intraday purposes, when I see a rally like this and I want to know again how much further should I hold on to a trade, we talked about this yesterday. with this move and how it was running right into resistance or support on the yen, and things were flattening out on the dollar, and it really wasn't going anywhere until we had that breakout, right? So prior to that, I'm going to be careful and I'm going to pay attention to when certain, sometimes you can find certain areas where the market's going to take its cue from, meaning that it's going to look at it for confirmation. The dollar, the yen futures, things like that. So let's say the dollar, for example, when the dollar starts to rally and move up into, prior to breaking out like it did yesterday, when it starts to move up into resistance and then it flattens out and goes sideways, and you can see it, it's not going to go any further, it's not going to break out. It usually, not always, but it usually will affect the Forex market across the board, depending on the time that the dollar reaches support or resistance. So let's say that the dollar reaches resistance and it's right around lunchtime or shortly after lunchtime, New York time. Well, at that point, we know people are probably, there's going to be fewer people participating in trading, volume levels drop, and the market's going to close shortly after that. So if the dollar's going to flatten and go sideways, go nowhere, and then the euro dollar and the pound dollar and the rest of them hit a support low or support high, and then they go sideways and flatten out, you can at least prepare yourself psychologically. If you're going to hang on to a trade and see what it's going to do next, then you know you've got, maybe the rest of the New York and possibly the Asian session to wait until momentum picks back up again. Sometimes the Asian session can be pretty slow. So now you can mentally prepare for how long you're going to hold on to that trade. If you're willing to hold on to the trade for another 12 to 18 more hours, which I don't personally recommend, I don't like doing that. I call it babysitting a trade, and I really don't like doing that because you can end up sitting there watching hour by hour or every 2 hours. It's hard sometimes psychologically to let go and trust what's going on. So then you're staring at it all night long when you should be sleeping, resting so that you can come back the following day and then be fresh and wait for a real breakout until I trade it. So sometimes you can end up falling asleep. Like I remember doing that back in 2001. I would sit and babysit a trade for like 12, 13, 14 hours. I wasn't paying attention to these concepts about trying to identify when the market's likely to just stop trading for the day and it's not really going to go any further than that. Sometimes you can see it. Sometimes you can't. But sometimes you can clearly see it, like one of the things that we were talking about the other day with the dollar, and it actually did it. Things flattened out everywhere, and it was done for the day, and things went sideways. So again, at that point, if I'm in a trade, I would decide, well, I'm just going to lock in profits with what I've got, or set maybe a break-even stop, or whatever the case is, whatever the trade requires. Or again, if I'm going to hold on to the trade, then I know I'm going to be holding on to the trade for 8, 9, 10, 12 hours, maybe 1 or 2 trading sessions. I did that, and then I would fall asleep once it would finally hit a target, and then maybe an hour or two later, that's when the New York market would start, and then there would be a big breakout, and I was asleep because I was sitting there watching the other trade for 18 hours when I shouldn't have, and I should have been sensitive. I should have had the ability. Ultimately, I ended up, developing that ability, but you've got to have that ability to identify when the market's giving you the information, to identify when it's likely to stop and go sideways and not go anywhere else. And it usually will affect the markets. Usually you can take that, you will find that source is the dollar. Not always, not always. Sometimes the dollar doesn't do anything and another currency pair will be moving all by itself because something's happening there in that particular country, whether it's Eurozone, the UK, something like that. You get the point. It's not always going to be like this. So like what I say doesn't play out every single time, every single day at the exact same time. It just doesn't work like that. And you know that if you've been trading for a lengthy period of time. But I think it's important with some of these ideas that I'm sharing with you now to start looking for them and prepare yourself for learning them and getting that exposure to them, gain that experience so that you can quickly set up your trade station, your platform, what you're looking at throughout the day so that you can quickly identify these things. It's going to make it a lot easier to decide to close out a position if you're in profitability and you can see that it's not going to go anywhere and you're done for the day, and then you say, okay, I'm just going to reset and look for another trade tomorrow, come back, do the same thing. Or if you're in a trade and you want to hold on longer, prepare yourself for, you're going to be holding on to it for a while. And if you're not in a trade and you see it stall and maybe hitting resistance, you can say, okay, well, it looks like everything's done for the day. You can see it. You can see volume levels dry up. You can see, you know what time of day it is. And then you can see resistance or support. And you can see maybe the dollar stalling. These things right there are going to help you make a decision or help you avoid getting into a trade where it just goes sideways and it doesn't do anything. Even though you see some strong, solid bullish candles and you think, oh, it's going to keep going for the next hour. And it doesn't. It's going to help you identify that so that you don't jump in too late thinking there's going to be more, and then you're wondering why in the hell is it going sideways? When is it going to pick up? You could have avoided that if you would have seen certain things. So I'm going to teach you that, how I do it. And again, how I do it is not the only way to do it. It's just the way that I do it, and it works for me. And it doesn't always, the market isn't always giving me these clues. Sometimes I got to work harder. And sometimes I reach that point where if I'm working harder at trying to find sources and information and clues and pick up some of this information, but it's just not there, then that by itself is also telling me stay out. You work too hard to find information that really isn't very obvious, and you're not too sure about what you're looking at, then you go ahead and you make a decision. Then you're likely to, because you're not 100% confident in the trade. There's something missing. There's something wrong, and you may not have the whole picture and all of the the confirmation that you need, and you may get into a trade that just fails, and it's because you got into a trade that you just really weren't too sure about to begin with. We're always going to get the opportunity. The market always will give us the opportunity to take the sure bets, the trades that look picture perfect. I refer to them as picture perfect. Those picture perfect trading opportunities are the best ones. They work. But they don't always set up every day. The market's going to make you wait for it, and the market's going to test you and see what you do between all of those opportunities. And this is definitely a time when we really want to be careful. So these indicators right now aren't really giving me any opportunity to trade reversals, and I wouldn't even consider trading a reversal. This is a 30-minute chart on the dollar yen. I wouldn't even trade anything here just yet. Pound dollar. Again, pound dollar breakout. I don't know if it's going to continue higher. I'm going to be watching the dollar. And then this is the euro dollar. So once the euro dollar has finally hit that final 55 pip target, this is another thing. Even if I took the trade and earned the first 20 to 25 pips, and then I got stopped out at break even, and then it came back down. Let's say I didn't even trade this, but I was watching, and I knew where my target was originally. And there's nothing, again, there was nothing wrong with the structure here. It's just the retracement was a lot deeper than normal. So at this point, if I was in this trade and it reached the 95, then I'm going to say, okay, well, I'm done. I'm not going to hold any longer. It might go lower. It might go lower. And if it does, then maybe it'll give me an opportunity to find something else, maybe on a larger time frame to confirm that trade. But right now, the trade plan is on a continuation breakout trade, 55 pip stop, 55 pip take profit. If we're in an environment like this, we want to scale out. So again, noticing what's going on and what's taking place, now I see that price reached that final target. So I would be done with that trade, and I would reset, close my positions, I'm flat, and then I look for another opportunity. So is it possible, now that it hit its target, that it's going to bounce? Well, I don't have any clues or signals that it's likely to do that. I would have to go to, because the indicators here are for the breakout, not for reversals. So I would want to go back over to this chart, and this is all on MetaTrader. I'm showing you MetaTrader today instead of the other platforms that I use, the chart programs. Because most of you are using MetaTrader, and I have templates. I can provide you the %B bandwidth, the other indicators that I'm using. Pivot points, I like these pivot points a lot better. Anyway, so you can add that to your MT4 platform and then create a template out of it and then drop it into your chart. So at this point, I still need more information to determine that this is a temporary support, even if it's just technical, even if it's just temporary, where price, this move here to the downside is done temporarily. It doesn't mean that it won't go any lower, and it does not mean that it's going to bounce and reverse and go all the way back up. I still need more information. I still need this indicator to confirm, in a more reliable manner. Right now, it's just sort of turning into what I could expect it to look like, but I need to continue to follow and wait for confirmation. I don't have it just yet. And even if I see it stall here, I've got to start looking at the larger time frames and start really digging in and find more information about as to whether or not this is actually going to be a low where price would bounce significantly and I could trade it to, let's say, a psychological level back up and earn anywhere from 30, 40, 50 pips on a Tech 1 trade. I don't have that yet. I don't have that yet. We're looking at a 30-minute chart. I really don't want to look at anything too much smaller than that. Maybe, toggle through between a 15-minute. Sometimes it'll give you a slightly early warning, but I would prefer to execute on a 30-minute with the Tech 1 trade or a 1 hour. Much more reliable. When I see it, it usually covers a greater distance, meaning that I'm going to earn more profits, and it'll justify the stop loss that I use, because this is not an HL30 where you're using 20 pip stop, 20 pip target. This is different. So again, I still have to wait, but we're looking at, what is it, 1:20 in the afternoon New York time, right after lunch. Market's going to close shortly later, in a little while here. It looks like, excluding a few maybe spikes to the downside or to the upside, there probably won't be a whole lot of activity for a few more hours. So after the 5 o'clock rollover, we'll take a look at it. HL30s, I've been saying that to avoid HL30s. Now, occasionally, an HL30 is going to work in this environment, and the 20 pip stop and the 20 pip target will hold. But it isn't going to usually work in this environment. So again, I'm going to avoid it until I know things are returning to a more consistently reliable and trustworthy environment, which is what markets need. We need to depend on things to be, working as normal, as usual. It's a typical environment. So again, I'm still going to avoid the HL30s. I know that some of them are going to work every once in a while, but a lot of them are still going to fail. So just avoid them altogether. If you're going to trade an HL30, look at it as a Tech 1 trade. So if you're going to use the Tech 1 trading, you're just getting familiar with it. Watch the Tech 1 videos in the module and the membership area, that particular module. I think there's like, I don't know, maybe 10 lessons in there and different examples of how I'm using the Tech 1 trade with news and things like that. And just follow along, and then we'll work on it together, you and I. When I see a Tech 1 trade, I'll call it out. In the meantime, though, it has been a very slow, flat trading day for me. I showed you the dollar yen. I'm not trading the dollar yen. I know that there was some movement there, but it's extremely unpredictable and unreliable to me, the way I trade it. Dollar Swiss, I didn't trade this move here. It was moving right into that resistance area, and it looked like it printed a breakout, so maybe this one could go higher. It's interesting because the dollar Swiss printed a continuation breakout trade to the upside, and the dollar's moving higher, and then the pound dollar printed a continuation breakout trade. So again, if we don't get a 3 pip entry on the pound dollar, then we never go long anyway, and it would help us avoid this possible head fake where it looks strong and then it drops and goes right back down the opposite direction. That's a head fake that's what I call it. Some people call it a whiplash, whipsaw. I call it a head fake. And the 3 pip entry keeps us out of trouble. We're not tempted to go into the trade until we actually see the 3 pip entry. Either way, it's possible that, if this one gives us the 3 pip entry, then maybe the dollar Swiss does not give us the 3 pip entry. Something to that effect. And then it becomes much more apparent and obvious when we go back and start digging for more information. Maybe the dollar tops out and it starts to drop down with a solid maybe 1 hour engulfing candle or something like that. And then we get more confirmation that it's reached a resistance level. So that's what I'm going to be doing moving forward. It's been pretty slow this week for me. Not too many trades, but it doesn't mean that, maybe by the end of this week or next week, it won't pick up. It certainly can. It can pick up at any time. That's the big thing that you need to take away from this, is that you have to be prepared and be ready, set up your charts, and when you can identify that things just aren't going to go any further and things are going to slow down, take consideration of the time of day, stop, take some time, rest, recover, because you're going to be on the spot when price finally breaks out, let's say during the London or New York session, and you're going to have to make a critical decision. And you don't want to be tired when you're doing that. I did it. I tried it. I used to trade, in a state of total exhaustion, and it just doesn't work. Anyway, so I'll leave it there. That's what we've been doing so far, and this is what I'm looking at. The fact that I haven't traded the dollar yen does not mean I won't trade it. It just means I haven't traded it yet today. So I'm still looking for opportunities there.